Good morning and welcome to our webinar on the uncertainty in Ukraine and beyond. I'm Jason Brown, the Director of Advisor Success here at Foster Group, and I'm joined with my colleague,
Kent Kramer. I'm the Chief Investment Officer at Foster Group.
And Ken, I'm going to start us out with this. It's Masters weekend.
Oh,
he didn't know this was coming. Who's your pick?
I'm always a Jordan Spieth guy.
Okay.
I just like his game. Although I watched Zach Johnson this morning tee off early.
Well, you're
Zach.
an Iowan.
Love Zach.
Yeah. So I'm thinking Colin Morikawa or maybe Scotty Scheffler. We will probably be wrong.
Yeah.
About that. And of course, having Tiger adds a lot of intrigue as well.
Lots of fun.
So I'll be checking my phone throughout for scores, but carefully listening to Ken as well.
Yeah.
So welcome. Just a few housekeeping notes to begin with. First of all, we're going to be with you for about 30 minutes. The hope is we'll get done in enough time to answer a few questions. Speaking of questions, there's a button at the bottom of your screen, so you can submit a question that way. If we have time, we're going to get to it. If we don't, we will get to all of the questions at some point in the near future. And then finally, this webinar is also being recorded, and you're going to be sent a link to that in the next few days. So, Ken, as we start today, I've been to Ukraine 3 times. So,
Wow.
Yeah, 2 for 6 weeks. It's a country that's very dear to my heart, and I want us to start by just talking about the consequences to that country and that people.
Yeah.
Because of the invasion of Russia.
Yeah. When we had talked about this, we felt like we needed to start with just acknowledging the humanitarian issues and crisis that's there. I mean, we're going to talk financially here in just a little bit, but you just can't escape what's happening with people. And the refugee crisis is amazing. It's the largest refugee crisis in Europe really since World War II. We've been seeing plenty of images of that. I think the most kind of amazing, startling statistic is that over 25% of the population of the country has been displaced by the war. So over 4 million people have emigrated. Over another 6 million have been displaced from their homes. So you think about 25% of the population of a country of 40 plus million people no longer able to dwell, at their home that they're used to. That's an amazing number. And it tells you a little bit about why there's so much economic impact, especially on those 2 countries. On Russia, maybe less so, although with the sanctions that are being implemented, there will be significant impact on their economy. But just the displacement in Ukraine is going to make it very difficult for them for the next, who knows how long, and to get their production and have a normal economic year.
Yeah, so the impact on those 2 countries and obviously the people of Ukraine is tremendous. Now, we had a few questions submitted just about, so what's the impact on our portfolio, our investments?
Yeah.
Should we be thinking about Russia, Ukraine? And the truth is, it doesn't have much of an impact on our portfolios.
Yeah, I think in that one, we have to think about kind of a direct impact question versus an indirect impact. So if you think about the direct impact, this kind of war between 2 countries has a dramatic impact on their GDP, their market, their production. So this was a quote from The Guardian where they were looking at a contraction of their economies by as much as 35%. This was a few weeks ago.
Yeah.
So as things go on, that number is just going to get higher. The other thing that I would say about kind of that direct impact, though, is for most investors in a globally diversified portfolio, at most, they would have held maybe 1/3 of 1% of their portfolio in Russian equities. Now, that would have been before the pandemic or before the war. Gosh, lots of crises here to worry about.
Yeah.
But since the war began, they basically had to close their stock market because of all the sanctions against it. The index providers basically removed Russia from emerging markets indexes. In essence, the value of Russian securities went to 0 for the time being. People can still hold the certificates of shares, and maybe in the future, those things will have value again. But right now, they're being carried by most people at basically 0. So the direct impact is very small. Again, 1/3 of 1% would be the most, but the indirect impact is what we're seeing, right? Where, hey, this is, yes, happening in one kind of location in the globe, but there are ripple effects. And some of those ripple effects have to do with inflation and things that were actually happening before the war began. And this has just exacerbated it. But certainly other things have to do with what's happening there and could it spread, or how will it spread?
Yeah, so talk to us a little bit about kind of the threat to the global economy. And, Russia's a relatively small player
Yeah.
in that. The problem is
Mhm.
they account for a lot of very important things
They really
to the world economy.
They really do. They have a significant percentage of the supply, or they supply a significant percentage of oil, which is
Mhm.
obviously big for global energy. They supply an even larger percentage of natural gas. So think about heating, power generation, huge supplier there. They also supply things like precious metals, industrial metals. And then if you look to the far right on this chart, you can see their supply of wheat. And if you combine Russia, how they supply wheat, with how Ukraine supplies wheat, the New York Times estimated as much as 25% of the global supply of wheat comes out of those two countries.
Wow.
And the longer this thing goes on and their planting, harvest cycle, shipping is all disrupted, that creates a lot of problems for countries, people that are relying on that food. It's causing prices to rise. You can kind of see on the left-hand side of this chart as well over here that in terms of global GDP, Russia represents a relatively small part of total global production, less today, obviously. Ukraine is less than 0.17% of global GDP. So again, small in one sense, but the ripple effects because of this globally connected economy, people are feeling it.
So you connected this to kind of something that was happening before, which is inflation.
Yep.
So just talk to us a little bit more about inflation generally, and then also how what's happening is directly connected to that too.
Yeah, absolutely. So if you think about where we were coming out of the pandemic, well, we had a lot of depressed demand. People were staying at home. We weren't able to travel or spend in the way that we normally would. We were also receiving, a lot of people were receiving a lot of economic benefits from the government. So there was a buildup of the cash, the ability for people to spend. So now that the economy started to open up, the world started to open up, people's demand, their demand for goods and services, wow, it really ramped up. Because we had shut down the global economy, supply could not ramp up as fast. Well, when you have a demand growing faster than supply, basic economics would say you're going to have inflation. The price of goods are going to go up. And we saw that before this whole thing with Russia and Ukraine happened. Then this event happens. And, part of the things that we need when we want to travel, well, we need energy, we need oil. There were lots, and then supply chains begin to slow down again. So that demand continues to go, but supply is even more constricted. And sure enough, inflation goes even faster. If you look at these two measures of inflation, the CPI is the orange line there. It was at 747 at the end of February. It's probably going to be higher here at the end of March. Gosh, that's a big number. That's the largest number we've seen since the 1980s. The number below there, the purple line, that's the number that the Federal Reserve looks at when they're measuring inflation. It's an interesting number because it strips out the effect of food and energy, which they take it out because they're volatile. But for you and I, for all of us, our experience of inflation is largely tied to food and energy. So that orange number really does represent, I think, what people are feeling.
Yeah. So, a certain amount of inflation, probably good. But this is well beyond what the Fed would like to see within our own country. So what are they up to try and curb this inflation?
That's right. So the Federal Reserve, they have kind of two big mandates. If you watch the news at all, you hear people talk about, well, it's to moderate inflation and to help with the full employment numbers in the economy. So we've seen since the pandemic, unemployment rates drop dramatically. Matter of fact, there are more jobs available than there are people to fill them. So the demand for employees is high, causing some wages to rise, which some people would say, well, that's a reasonable thing. We're happy to see people get paid a little bit more. At the same time, it feeds into that inflation narrative, just one more pressure on prices. So the Federal Reserve would like inflation to be somewhere between 2 and 3%. That's kind of their long-term target. Well, we're obviously way out of that range today. One of the tools that they have to control inflation, monetary policy, is to raise interest rates. They really only directly control one interest rate, but what they do is they communicate their desire to have interest rates rise. They say, we're going to raise our rate. And then the rest of the world says, well, that means rates in general are going to rise, even though they don't directly control them. And the way that they kind of indicate what they want to do with interest rates is something called the dot plot. And you can see that on your screen right now. And the dot plot sounds like a very fancy statistical measure.
It does, yeah.
All it represents is the federal board of governors, the people who have a vote on what they do with that one interest rate. This dot plot, each dot represents one person and their vote for where they think interest rates should be at this date on the curve. And so the dot plot just shows kind of the spread or the difference of opinion amongst those people who are going to vote at the Fed to set the interest rate. But you can see what they're saying is we are expecting to vote to raise rates.
Right.
And the market has said, wow, okay, they're voting to raise rates. That tells us something about what they intend on doing. The market doesn't have to wait for the Federal Reserve to raise rates. You can just react right now.
Yeah. Well, and you've got a little chart that shows us, I think that reaction, that immediate reaction, the Fed hasn't actually done a lot.
Right.
They've talked about what they're going to do,
Yes.
but the market has already responded to that.
Yeah, that's exactly right. And I appreciate that. Actually, I think the Fed's learned a number of things, over the last number of years. Is like the market doesn't like uncertainty, surprises. So they want to get way out in front and say, we are seeing this and we are planning on doing this in the future. And they've been doing a good job of signaling we're going to raise rates. We see inflation. Some people would say they've been talking about it for too long and they're already behind the curve, and there's difference of opinion on that. But if you look at this chart, this is something called a yield curve. And all it's doing is it's plotting the interest rates associated with different treasury securities based on their maturity. So very short maturity treasuries over here on the left-hand side. These are securities that are going to mature. They're going to be redeemed by the Treasury sometime in the next 30 to 60 to 90 to a year. And as you go out to the right, these are Treasury securities that don't mature for 30 years. So this green line right here, the bottom one, that's where interest rates were on the curve in the marketplace in June of last year. This orange line represents where those same rates were at the end of 2021. And here's where they were on March 16th. And the thing to notice is the shift up in rates in the short term. Again, the Federal Reserve just last week raised interest rates 1/4%. But look at this shift.
Dramatic.
This is the market saying, hey, the Fed said they're going to raise rates by 2% or more in the next year. We don't have to wait for them to raise rates. We're just going to go ahead and start expecting or requiring those rates now. The other thing that I'd point out on this chart is when people talk about an inversion of the yield curve as an indicator of recession, what they're talking about is this 2-year security, the interest rate on that going higher than the 10-year security right here. So if this thing goes higher, if these short-term rates go higher than this 10-year, what you have is an inversion. And there's some academic research that's been done in the past would say when you have an extended inversion of particularly the 2 and 10, maybe a recession is coming. Now, at the same time, that research would say it doesn't tell you when or how soon it's going to happen, but it just becomes more likely.
So this growing inflation, what impact has it had on the market?
Yeah, well, the market, two things I would say. The market is, there's a bond market. So what is it doing to the bond market? And then what is it doing to the stock market?
Okay.
The stock market is always volatile and it's responding to economic conditions all the time. So if the stock market thinks that economic growth is going to slow, and if sometimes inflation has a slowing effect because the Federal Reserve is going to come in and try and tamp it down. Also, what we see in Russia and Ukraine creates uncertainty. The market doesn't like that either.
Right.
Stocks. So you see stock markets, they generally decline pretty broadly in the first quarter. As interest rates rose, just what we looked at that yield curve. Well, when interest rates rise, bond prices fall. It's just a mathematical formula. And you can see that here again, the orange line shows kind of the bond returns broadly in the US in the first quarter. It was the worst quarter for bonds since the 1980s.
Yeah.
And that's because of the rapid increase in rates. And that just causes those bonds that are already in the market to go down in price. There appears to be in that yield curve, a lot of the future interest rate hikes are now priced in.
Got it.
So we wouldn't expect bond prices to be as much under pressure going forward. And it's always possible that we could say inflation get really out of hand and the Federal Reserve has to raise that dot plot. But if things are close, let's say, then we've probably seen the most significant adjustment in bond prices.
So the worst bond market period since the early 80s, the worst inflation we've seen since the early 80s.
Yeah.
A war in Europe, which we haven't, a land war, which we haven't seen since 1940s.
Yeah.
That's a lot of uncertainty. We feel that, Kent. And, you know, whenever we get into these periods, which happen a lot more than we tend to remember,
Yeah.
We kind of think, is it different this time? Should I do something different with my investments?
Mhm.
Um,
Yeah, it's really true. We asked the question, will it be different this time?
yeah.
So along the way here, as we talk about this, periodically, I find myself laughing. I want you to know I'm not laughing because it's not significant. I'm kind of laughing at myself, honestly. Because when we talk about the past, it's easy to look at the past and go, can you believe we worried about that?
Mm-hmm.
Or, wow, that was really ended up not being as big a deal as we thought. And so we look backwards and go, and we can chuckle about it. It could sound like we're making light of the way things are now or how people are experiencing it. And I don't mean to do that at all, because like many of you, that kind of uncertainty causes kind of a check in my heart and mind too about, well, what does this mean for my investment portfolio personally? This book, I have not read the book. I just came across the title in a quote by Morgan Housel, but Dan Carlin has a podcast, and his podcast is called Hardcore History. He's a well-known historian. He tells great stories. But what Housel talks about when he references his book, he said Carlin has just cataloged all these times in history where it seems like the end is near. People think this is finally going to be it. The world is going to end as we know it. And what happens is we get through it every time. So these end is near circumstances, they exist, as Housel says, in every area, in every era, every continent, every culture. He would say bad news is the norm. We don't like it, but if we think about it, it tends to be that way.
It is.
Yeah.
So when we were planning for this, we kind of agreed, hey, let's take off your chief investment officer hat and just talk to us as an individual investor. And you just very personally, and I think the question I asked you is, hey, Kent, in times like this, what gives you confidence? What keeps you operating with hope?
Yeah.
And I want us to, I'd like to hear from you, like just personally, what you go back to.
Yeah. I think that hope, that hopefulness or optimism, when I think about conversations with anyone really around investments, there's plenty of voices in the world who want to get our attention by creating fear, promoting almost.
I don't have to work very hard at it either.
Yeah, there's plenty of things to look at that can cause you to go, whoa, that looks pretty bad. And for some people, their experience right now is very bad, right? So it can get our attention and think, well, if that's happening, then everything is going to go down with it.
Right.
We're all going down. And the problem is human history would say that's just not the way it's worked. Human beings, so 3 stories. One of them is human beings are problem solvers. And that's especially true in crisis. You don't have to look back more than 2 years. Think about the pandemic, huge crisis. Immediately, human beings go to work on solving the problem. We believe that we can find a solution to the problem. And if you think about the last 100 years, there have been plenty of problems. I've just listed a few here. But in every case, we've come through those problems as a world, and we've continued to progress. There's a chart that Bill Gates really likes. This is where I got this chart, was from a tweet that he put out, 200 years of progress. There's a group at Oxford in England that tracks this stuff. But if you look at the progress in the midst of all these crises over the last 200 years, look at the change in extreme poverty. The number of people, this red section representing the number of percentage of people in extreme poverty around the world, that's declined dramatically, right? And we look at basic education, the ability for people to get basic education, gone up dramatically. Literacy rates, actually the spread of democracy, even with what we're seeing right now, overall, things have gotten better. And this is just, more and more and more. Vaccination is a really interesting one, right? Based on what we've seen currently. Look at that, how much more available vaccines are, life-saving vaccines are to people around the globe. So the point here is, when crises come into play, human beings tend to react in a sense like, we have to solve this problem. Yeah. We don't just go retreat and say, I'm just going to sit here and wait for the end to happen.
Okay. Yeah. So connect that then to the markets themselves, the sense that we are problem solvers.
Right.
How does that impact the market then?
Yeah. So if you're somewhat of an optimist about the future, so if I look at these problems and I think, there's a pretty good possibility or probability that human beings are going to solve the problem in one way or another. What that means is the market economies are going to continue to operate. So yeah, there's lots of things going on that need problem solving. And part of the problem solving actually happens with some of those companies. So then let's just use the pandemic as an example. The pharmaceutical companies dove right in and said, we're going to figure out how to solve this problem, if it's at all solvable. Well, if you're an investor in a pharmaceutical company and they solve the problem, you're the beneficiary of their work. You're helping to fund it. We've talked about investment, what that means in the larger sense of the word. You're invested in companies that are trying to solve problems for humanity at that point. The market is full of companies that are responding to economic events, to the kind of the lay of the land. And what they're doing is they're saying, hey, we need to find ways to both solve problems and to be profitable. And over time, the record is pretty clear. I'm just going to kind of click one ahead here. There's been a lot of problems, but if you look at the performance of markets broadly, they've continued to grow, provide positive return to investors, largely because companies have been successful in coping with the difficult circumstances around them and being part of the problem solving.
I really like that. It's a hopeful outlook. I think it's also true. And then there's a third point you wanted to make as well. And I need to preface this by saying when Kent shared this point with me, you said it comes from the single most influential investment presentation he has ever participated in.
Yeah.
And you've been to a few.
I've been to a few.
Yeah.
Yeah. In the last 30 years, I've been to a few.
Yeah. And this is the most, so I think that's my way of saying, hey, listen.
Yeah. So the woman who gave this presentation, she works for an investment firm in Austin, Texas. And I've got the opportunity to know her personally. And so anyway, she's a wonderful researcher, but this particular presentation that she gave, it just talked about the performance of the global stock market. And she was using some data put together by a group of researchers, Dimson, Marsh, and Staunton. You see that there in the bottom of your slide. They wrote a book called The Triumph of the Optimist. And the point of the book was, as we just talked about, equity markets have tended to rise over time because of the optimistic approach of human beings to the marketplace. But in her study, she looked at a century of global returns, and there have been some really bad periods. And if you look at the United States, we had a calendar year where we were down 60% on an equity market. If you look at Germany, Japan, and France was in the path of World War II. They had a period where they were down 98%. So imagine your stock market, your home stock market being down 98%. And in the case of World War II, staying down for years on end before they recovered. The worst case for the global market, 53% in terms of a kind of a cumulative return. Now, the longest peak to trough to recovery, this is the one that really kind of grabbed my attention. Even with all those really bad stock return experiences, the worst case for the US, let's start with the US, peak to trough, meaning the bottom, the full recovery adjusted for inflation, worst case in the US, 8 years. Worst case for a single country, 45 years.
Yeah.
So that's a long time to wait. If I were a global market investor, so if I invested in all those countries that had stock markets going back for 100 years, and I just stayed invested in them, even the ones that went down 95% in my portfolio, my worst case peak to trough to full recovery, 7 years. So the reason why I say this was the most significant thing for me was it told me in the design of a portfolio, I need to plan. If I'm going to plan for the worst case, and for many investors that we talk to, they want to know, how do I plan for the worst case? Well, historically, if the worst case for an equity market has been 7 years peak to trough to full recovery, then I need something else in my portfolio other than stocks to cover my cash flow needs for at least 7 years and probably more. But I also look at that and go, but if that really is the worst case that we've seen, 7 years, then while things look dramatically bad, let's say at different times, my time horizon tells me, well, if I'm covered with lower risk, higher probability liquid investments for, let's say, 7, 8, 9 years, or I have good income, whatever it might be,
Yeah.
then I can rest. I can kind of ride out that market return. The other thing that I took away from this that was so important for me was the single country risk idea.
Yeah.
So some people look at that and go, well, why would I just not invest in the US? It's been the best performing market.
Right.
Right. And by and large, we have had the strongest stock market off and on for many, many decades. That's just in the data. The thing is, I don't think Germany or Japan or France saw, 2 years ahead that their market was going to crater because of World War II.
Right.
They thought they were strong countries. Their market went down dramatically. So when I think about global diversification, to me, the lesson here is I want to be broadly diversified, and I'm willing to pay for it with a little bit less return because I want the buffer of if something just off the map were to happen to the United States, I want to be broadly diversified enough so that I have equity returns in my portfolio are still positive, and I still have bond and cash so I can make sure I can meet my kind of nearer term expenses.
Yeah. And there were a couple of things I think that you said, lessons to apply to that I think are worth saying as well.
Yes. So great point. I'll skip that one and we'll just go right to the lesson. The lesson for me is it's kind of a reinforcement. This is one that I've said to a number of people for many years. I really believe it strongly. One of our investment principles at Foster Group is to embrace uncertainty.
Mm-hmm.
And what that tells me is I need to be a short-term agnostic. And what I mean by that is in the short term, I'm really not overly optimistic or overly pessimistic. I just don't think you can really know exactly what's going to happen.
This is very disappointing, Kent. You're our chief investment officer.
I know. Cat's out of the bag once again. But the idea and the studies would just say a lot of people try to do this. Very few are successful, and almost none are successful on an ongoing basis.
Yeah.
So I don't want to build a portfolio based on the idea of short-term prediction. I'm just going to be agnostic.
Yeah.
But when I think about long-term history, so go back to that most influential presentation, 100 years of returns, the triumph of the optimist, I choose to be a long-term optimist. I still think human beings are going to solve problems.
Mm-hmm.
And as we solve problems, one of the places that's going to benefit from that is markets. We're going to see growth. So I'm going to expect progress and remain optimistic.
I like that a lot. And there were two things too that came to mind for me. They're not surprising. Just as I think back on my now 6 years of being here, talking with you a lot, if you can keep these two things in mind, just stay diversified, be in a diversified portfolio. And then the second thing is just stick with it.
Yes.
And I just want to pull back a little bit. When we talk about investing too, it's investing in the market, stick with it there. But just as human beings, stick with investing in your kids, in your closest relationships, in your communities, with the organizations that you serve or you're a part of. Stay with it.
Yeah.
Stay invested as a human being just generally. And in one of those ways, stay invested in markets too.
Yeah, because if you're optimistic, if you choose to be optimistic about the future, then you want to build into that future. And the more people that choose to be optimistic and to build and invest in a better future, it's just better for everybody. It's an absolute win-win.
Okay, so I almost every time I say, Kent, you get the opportunity to say whatever you want to say to us at the end of these things. So here it is again.
Well, so when I do that, oftentimes I have to quote somebody else because they say it so well.
Yeah.
So the top quote is one I just love. Risk means more things can happen than will happen. And that just means we all will find things to worry about. And we'll spend a lot of energy worrying about things that are not going to happen because risk, and we are taking risks when we invest in the future. There are things that can go wrong. And risk just means, but it does mean more things can happen. There's lots of things that could happen, but not all of them will. So I like that. I think that's a truism. The other one, I love Churchill. This is one I think keeps me out of trouble. I avoid prophesying beforehand because it's a much better policy to prophesy after the event has taken place. You just set yourself up for fewer failures when you look at it that way. Really, all that's saying is beware of being too confident that you know what the future holds. Instead, keep investing in trying to solve the problems, stick with the plan. Just we said, be diversified, stay invested. All those things are things we can do productively every day. And we can help each other do it. I think that's, part of this type of a conversation that we're having with you today is we want to encourage you in ways that will help you to keep at it, even in the face of things that seem really daunting and difficult. And there are some really difficult things out there. But the idea that we won't get through it, if we start to believe that too strongly, we really, I think, lose perspective, again, about the capacity for human beings to solve problems and work together.
Well, thank you so much, Ken. And also thank you for joining us. We don't have any time for questions right now. So if you sent any in, we will make sure to respond to those. And just a few reminders as we wrap up today. This has been recorded and you're going to receive a link to this. And we would really appreciate your feedback too. So there's going to be an opportunity for you to give us that. We really are grateful when you let us know how we're doing and even share ideas about how we could do things better. And then to our clients who joined us, we just want to say thank you for joining us and thank you for the privilege of serving you. And to those of you who aren't yet clients, I think it goes without saying, but we'll say it anyway. We would love the opportunity to talk with you and help your financial life be truly cared for. So thanks again for joining us. Bye.